$4.9 trillion. That is how many new dollars the Federal Reserve created between March 2020 and April 2022. More money printed in 25 months than in the previous 220 years combined. The stock market went up 114%. Home prices went up 40%. The top 1% added $6.5 trillion to their net worth. And you got a check for $1,200, then you got another for $600, then one for $1,400. So let me ask you the only question that matters. If they printed almost $5 trillion and your total share came to $3,200, where did the other $4.9 trillion go? I'm going to show you exactly where it went. The banks it passed through, the corporations it ended up in, the houses it bought, the stocks it propped up, and why the playbook they ran on you in 2020 is the same playbook they ran in 2008, the same one they ran in 1971, and the same one they will run again. This is not a theory. This is the Federal Reserve's own balance sheet. Here's what they told you. There was a pandemic. The economy was going to collapse. People would lose their jobs, their homes, their savings. So Congress and the Federal Reserve stepped in to save ordinary Americans. They passed the CARES Act, $2.2 trillion in relief, then a second bill for $900 billion. Then the American Rescue Plan for another $1.9 trillion. $5 trillion in 3 rounds. To help you, that is the version you heard on the news. Now here's the version in the ledger. Of that $5 trillion in fiscal spending, $814 billion went to direct payments to households. $814 billion out of $5,000 billion. That is 16%. The other 84% went somewhere else. Most of it went to businesses through a program called the Paycheck Protection Program. $790 billion. Sold to you as saving small business jobs. In reality, 70% of the money went to companies with more than 5 employees, and the top 1% of recipients absorbed a quarter of the total. Professional firms, hedge funds, real estate developers, country clubs, even the Los Angeles Lakers. They got their loans forgiven. Most Americans did not even know they could apply, but the fiscal spending is not the story. The fiscal spending is just the distraction, because while Congress was voting on trillion-dollar bills in front of the cameras, the Federal Reserve was quietly printing twice as much behind closed doors. And nobody voted on any of it. Here's how the machine actually works. Pay attention. This is the part they never explain. When the government wants to spend money it does not have, the Treasury issues bonds, an IOU, a promise to pay the money back plus interest. Normally, those bonds are sold to investors, pension funds, foreign governments, ordinary savers. But in a crisis, the Federal Reserve does something different. The Fed creates brand new dollars out of thin air, with nothing backing them, and uses those dollars to buy the bonds. Not from the Treasury directly, that would be too obvious. They buy them from a list of 24 banks called primary dealers. J.P. Morgan, Goldman Sachs, Citigroup, Bank of America, Morgan Stanley, the same names, every time. Here is the genius of it. And I mean genius in the darkest possible sense. The banks buy the bonds from the Treasury. The Fed buys the bonds from the banks. The Fed pays with money that did not exist 10 seconds earlier. The banks pocket the spread. And now the banks have trillions of fresh dollars sitting in their accounts, earning interest from the Fed itself, just for holding it. Let me say that again. The Federal Reserve creates money from nothing, hands it to the banks, and pays the banks interest to keep it there. They have a polite name for that, too. Interest on reserve balances. In 2023 alone, the Fed paid commercial banks over $230 billion in interest on money the Fed had created and handed them 3 years earlier for free. A single bank, J.P. Morgan, received $25 billion that year just for parking the money at the Fed. Not for lending it, not for investing it, for holding it. $25 billion in risk-free income from the same central bank that told you the system was being used to save jobs. This is not speculation. This is the mechanism. It has a name. They call it quantitative easing, and between March 2020 and April 2022, they did $4.7 trillion worth of it. But here is where it gets darker. Because the banks did not just sit on that money, they lent it at near zero interest rates to their biggest clients, corporations, hedge funds, private equity. And those clients did what anybody would do with nearly free money. They bought things. They bought their own stock. $981 billion in corporate stock buybacks in 2021. A record. Apple alone bought back $85 billion of its own shares. Why? Because a buyback shrinks the number of shares outstanding, which mechanically pushes up the price, which mechanically boosts executive compensation, because executive compensation is tied to stock price. So Apple borrowed nearly free money from a bank that got its money from the Fed and used it to make its own CEO richer. And every other major corporation did the same. This is why the S&P 500 went up 114% in 20 months. Not because the economy doubled. Not because productivity exploded. Because trillions of fresh dollars had to go somewhere. And the first place they went was into the stock market. They bought houses. Institutional investors, BlackRock, Blackstone, Invitation Homes, American Homes for Rent, bought single-family homes by the thousand. In some neighborhoods, they were buying one out of every 3 houses on the market. They paid cash. They paid over asking. They outbid the young family with the 30-year mortgage. And then they rented the house back to the same people who could no longer afford to buy it. This is why home prices went up 40% in 2 years, while wages went up 12%. This is why the median home now costs more than 7 years of median income. In 1985, it was 3. They bought companies. Private equity firms did $1 trillion worth of buyouts in 2021. Another record. They bought nursing homes, pharmacies, vet clinics, trailer parks, daycare centers. And then they did what private equity always does. They cut costs, raised prices, loaded the companies with debt, and extracted dividends until the company either collapsed or got sold to someone else. They bought assets you have never heard of, and some that did not even exist a year earlier. They pumped $85 billion into crypto. They launched over 600 special-purpose acquisition companies, blank check vehicles with no products, no revenue, and no real business, and raised $162 billion for them in a single year. They bought Picassos and Rolexes and racehorses. They bought abandoned buildings in cities they had never visited. They bought entire island resorts. A Bored Ape JPEG sold for $3.5 million. Because when 5 trillion fresh dollars enter a system, the price of everything rises, and the price of absurd things rises the fastest. And now, here's the part that should make you angry. Because all of this was predictable. Because all of this happened before, in 2008. Remember 2008? The banks had gambled on mortgage-backed securities. They lost. The system was about to collapse. So the Federal Reserve, under a program called TARP, handed the banks $700 billion. Then they followed it up with 3 more rounds of quantitative easing, totaling $3.5 trillion. The banks were saved. Their executives kept their bonuses. Nobody went to prison. And ordinary Americans lost 10 million homes to foreclosure. They told us it was a one-time emergency. Never again. They said it while they were doing it. Then 2020 came, and they ran the exact same play. Except this time it was bigger. $5 trillion in fiscal spending. $4.7 trillion in monetary creation. $9.7 trillion in 25 months. More than the GDP of every country on Earth except the United States and China. And they did it without a single congressional vote on the monetary side, because the Federal Reserve does not need permission to create money. It just creates it. And here's the pattern. Laid bare. 1971. Nixon cuts the dollar loose from gold. Purchasing power starts falling. Prices start rising permanently. 2008. Banks crash the economy. Fed prints $4 trillion. Bankers get bonuses. You lose your house. 2020. Pandemic arrives. Fed prints another $4.7 trillion. Billionaires add $6.5 trillion. You get $3,000 and 20% inflation. It is not a bug. It is not a mistake. It is not a series of unfortunate coincidences. It is a system, and the system has one rule. When the rich take risks and win, they keep the winnings. When the rich take risks and lose, you pay for the losses. Heads they win. Tails you lose? And in case you think the people who ran this play were unaware of what they were doing, Jerome Powell, the Fed chairman who ordered the printing, personally traded tens of millions of dollars in financial instruments while setting the interest rate policies that determined their value. Two of his regional Fed presidents were forced to resign in 2021 when the trades became public. Steven Mnuchin, the Treasury Secretary who designed the bailout, went from approving PPP loans to launching a private equity fund that raised $2.5 billion, much of it from the same foreign sovereign wealth funds whose access to U.S. markets he had just negotiated. Larry Fink, the BlackRock CEO, whose firm was hired by the Federal Reserve itself to manage the corporate bond buying program, saw his company's assets under management grow from $7 trillion to $10 trillion in 24 months. They did not just benefit from the system. They designed the system, ran the system, and then profited personally from the system. And nothing happened to any of them. And now let me show you what it actually cost you. Because you paid for this. You are paying for it right now. Every time you fill your tank, every time you buy groceries, every time you sign a lease. Between 2020 and 2024, the purchasing power of the dollar fell by about 20%. That is the largest four-year drop since the 1970s. The last time they did this. 20% means the $100,000 you had in the bank in 2020 now buys what $80,000 used to. Your savings did not shrink. Your money was diluted. Quietly, by design. While you were not looking, the median rent in America went from $1,450 a month in February 2020 to over $2,000 by 2023. That is a 40% increase in 3 years, in a decade where wages only moved 12. Your raise was a pay cut. Your promotion was a pay cut. Working harder was a pay cut, because the money itself was being debased faster than your paycheck could grow. Groceries went up 25%. A carton of eggs that cost $1.50 in early 2020 cost $4.80 by the beginning of 2023. Ground beef went up 30%. Orange juice went up 70%. Health insurance premiums went up 22% over the same 4 years. Car insurance went up 31%. A used car that cost $20,000 in 2020 cost $28,000 in 2023. Used. Auto loans hit record durations, 84 months, because the only way most families could afford the new prices was to stretch the payments over 7 years. College tuition went up 18%. Childcare went up 32%. The basic cost of existing in this country rose faster in 4 years than it had in the previous 15 combined. And in the same 4 years, corporate profits went up 71%, which is not a coincidence. When money supply expands and competition is already thin, whoever raises prices first keeps the extra margin. Call it inflation. They called it record earnings. And they call this price stability, 2% per year. They say it as if it is a target. It is a target. The target is you, because 2% per year, compounded, means your money loses half its value every 36 years. One working lifetime. You spend your entire career earning dollars. And by the time you try to spend them, half of them have been vaporized. They did not take them with a tax. They did not take them through a fee. They took them by printing more of them and handing them to someone else first. That someone else is not you. This is not broken. This is exactly how it is designed to work. The money goes up. Your share of it goes down. Every single time. For 50 years. And counting. If this changed how you see your paycheck, your rent, the cost of eggs, subscribe. Because this is only the second layer. Next, I'm going to show you the third. The one where the money you do have, the actual physical dollars in your wallet, is about to be replaced by something they can track, freeze, and expire at will. They did not print $4 trillion to save you. They printed $4 trillion because saving you was never the point. They printed the money, you paid the bill, and the receipt is already on its way.